There is a secret language spoken in the world of serious capital, a language not of spreadsheets and algorithms, but of character and culture. It's a language that Warren Buffett mastered decades ago, and it has been the silent engine behind the creation of hundreds of billions of dollars in wealth. This language doesn't concern itself with the noise of quarterly earnings or the fleeting sentiment of the market. Instead, it asks a single, devastatingly simple question that cuts through all the complexity: what does the office carpet look like? It sounds absurd, almost insulting to the intricate science of modern finance, but within that question lies a key, a powerful diagnostic tool that can reveal more about a company's future prospects than 100 pages of financial analysis. Buffett learned that the thread count of the carpet, the modesty of the furniture, the absence of a private chef in a corporate dining room, these were not trivial details. They were the physical manifestations of a leader's soul. They were clues that told him whether a CEO viewed the company's treasury as a sacred trust or as a personal piggy bank. He wasn't just looking for cheapness. He was hunting for an almost religious devotion to frugality, a sign that the person at the helm understood that every dollar wasted on ego was a dollar stolen from the pockets of the true owners of the business, the shareholders. This is the story of that principle. It is the story of how a deep understanding of human nature, specifically the corrosive power of ego and the quiet strength of discipline, became one of the most potent weapons in the history of investing. We are going to deconstruct this weapon piece by piece so that you can add it to your own arsenal. You will learn to bypass the slick corporate presentations and the charismatic CEO interviews, and instead learn to read the subtle, often invisible, signs of a corporate culture built for enduring success. You will learn to spot the red flags of the empire builder, the executive whose primary ambition is to build a monument to himself on your dime. And in their place, you will learn to identify the stewards, the quiet, owner-oriented leaders who treat your money with the same fierce protectiveness they would their own. This is not just a lesson in stock picking. It is a lesson in judging character at a distance, a skill that is paramount for success in any form of business analysis or long-term investing. This is the final promise of frugal leadership, the promise that the person in charge is working for you and only for you. Our journey begins with the foundational belief that underpins this entire philosophy: the owner's mindset. This is the bedrock, the core distinction between a manager who is merely a hired hand and a leader who acts as a faithful steward of shareholder capital. To truly understand this, we can't just talk about theory. We have to go back to Omaha, Nebraska in 1983. We have to tell the story of a woman who couldn't read or write English, but who could teach a masterclass in business and management quality to one of the greatest investors who ever lived. Her name was Rose Blumkin, but to everyone who knew her and her legendary work ethic, she was simply Mrs. B. She had fled Russia in 1917, eventually settling in Omaha. In 1937, with a loan of $500, she started the Nebraska Furniture Mart in the basement of her husband's pawnshop. Her business philosophy was radical in its simplicity: sell cheap and tell the truth. She was a force of nature, a relentless negotiator who would haggle with suppliers until she secured the lowest possible price, a benefit she passed directly to her customers. Her store became a local institution, then a regional powerhouse, all built on volume, razor-thin margins, and an obsessive, almost maniacal focus on controlling costs. By the early 1980s, Warren Buffett was a regular, albeit unrecognized, customer. He saw firsthand the massive crowds, the frenetic energy, and the sheer scale of her operation. He was witnessing a business that defied conventional logic, a single-store operation that did more volume in furniture than any other in the country. He knew he had to own it. The negotiation, if you could call it that, has become the stuff of legend. Buffett approached Mrs. B, then a vibrant 89 years old, and asked if she would sell. She agreed. He asked her to name her price. She thought for a moment and said $60 million. Buffett asked to see her financials. She famously replied that they didn't have audited financials, that they paid their bills, made a profit, and that was that. She ran the business based on two numbers, what came in and what went out. The difference was profit. It was the ultimate expression of financial discipline. Buffett didn't flinch. He simply said, "Mrs. B, I'll have my check for you tomorrow for $55 million." She agreed, they shook hands, and the deal was done. No army of investment bankers, no consultants, no legions of lawyers performing months of due diligence. Just a 1.5-page contract that Buffett wrote himself. Why? Because Buffett wasn't just buying a business, he was buying a culture. He was buying the physical embodiment of the owner's mindset. He knew Mrs. B treated every single dollar that flowed through the Nebraska Furniture Mart as if it were her own sacred property, because for most of her life, it was. When he bought the company, he was buying into that stewardship. He was buying a guarantee that the business would continue to be run with that same fanatical intensity. The story gets even better. A few years after the sale, Mrs. B, now in her 90s, had a falling out with her grandsons over her management style. They thought her approach of selling on such thin margins was too aggressive, so she quit. In a rage. At age 95, and what does a 95-year-old retail legend do when she quits? She crosses the street and opens a rival store, Mrs. B's Clearance and Factory Outlet, which quickly became the third largest carpet retailer in Omaha. She was competing with the very business she had sold to Buffett, and she was winning. Buffett, far from being angry, was delighted. He saw this not as a betrayal but as the ultimate confirmation of her character. It was pure, unadulterated entrepreneurial spirit. He eventually bought her new company too, and persuaded her to come back to work at the original mart, which she did until she was 103 years old, riding around the store in a motorized cart, still cutting deals and terrorizing salesmen. Mrs. B was the blueprint. She never thought of herself as a CEO or an executive. She was an owner. The money in the cash register wasn't abstract corporate earnings. It was her money, her family's money, and later, her partner Warren's money. This deep-seated sense of stewardship is the holy grail that Buffett seeks in every CEO analysis, because he knows it is the single greatest defense against the foolishness and waste that plagues so much of corporate America. This preference for the owner's mindset isn't just a folksy tale from Omaha, it is a sophisticated strategy that exploits a powerful flaw in human psychology. At the heart of it is the battle between two cognitive concepts, the endowment effect and the principal-agent problem. Understanding this dynamic is crucial for any serious business analysis. The endowment effect, a term coined by Nobel laureate Richard Thaler, describes our tendency to overvalue things that we own. In a classic experiment, participants were given a coffee mug and then offered the chance to sell it. The price they demanded was consistently twice as high as the price other participants, who didn't own a mug, were willing to pay for one. The mere act of ownership infused the object with a subjective value far beyond its market price. We feel a pang of loss when we part with something that is ours. Now, consider how this applies to a CEO. A founder CEO, or a leader with a massive personal stake in the company, experiences the endowment effect on a corporate scale. The company's capital is not an abstract pool of resources, it is their capital. The thought of wasting it on an overpriced, ego-driven acquisition or a lavish new headquarters triggers that same psychological pang of loss. Spending $1 million of shareholder money feels, on a visceral level, like taking $1 million out of their own family trust. They are endowed with a deep sense of psychological ownership, and this makes them instinctively frugal and protective. This is the mindset Buffett bought when he bought Mrs. B's company. She didn't distinguish between the company's money and her money, it was all one and the same. Now, contrast this with the principal-agent problem. In most large, publicly traded companies, the principals, the shareholders, the true owners, hire an agent, the CEO, to run the business on their behalf. The problem is that the agent's interests are often not perfectly aligned with the principals. The CEO might be motivated by things that don't maximize long-term shareholder value: a bigger salary, a larger bonus, fame, prestige, the size of the corporate empire they command. Their time horizon is often short. The average CEO tenure is only about 5 years. They want to make their mark, cash their options, and move on. For this type of CEO, the company's capital does not trigger the endowment effect. It's not their money. It's a resource to be used to achieve their personal goals. This psychological distance makes waste not only possible, but probable. Spending $10 million on a new corporate jet doesn't feel like a personal loss. It feels like a perk of the job, a symbol of their success. It's a rational decision from their perspective, even if it's a disastrous one for the actual owners. Buffett's genius is in recognizing that this agency problem is one of the single biggest destroyers of shareholder value. His entire strategy of finding frugal, owner-oriented management is a system designed to bypass it. He is searching for leaders who, either through a large equity stake or a deeply ingrained psychological makeup, behave as if the endowment effect is in full force. He wants a CEO who feels physical pain at the thought of wasting company resources, because that pain is the shareholders' ultimate protection. The frugal CEO isn't just being cheap, they are acting under the powerful influence of psychological ownership. They are behaving as if they are the principal, not the agent. This alignment is incredibly rare, and when you find it, you have found a powerful indicator of future portfolio growth. So how can we as investors translate this profound psychological insight into a practical tool? How can we systematically identify these stewards and avoid the agents? We need an applied mental model, a blueprint. Let's call it the grandma's savings jar model. Imagine a CEO's primary job is to safeguard and grow the contents of a simple glass jar filled with their grandmother's life savings. A good CEO treats the corporate treasury with that exact level of reverence and care. Your job as an analyst is to find the evidence of this behavior. Here is a step-by-step process, a series of questions to add to your investment checklist. Step 1. Analyze the language. Go to the company's last 10 years of annual reports and shareholder letters. Use the search function. Look for words like cost, efficiency, frugal, shareholder, and owner. How often do they appear? More importantly, what is the context? Does the CEO talk about costs as a burden to be minimized or as a strategic weapon? Does he refer to shareholders as partners and owners or as a faceless group to be managed? A true steward's language will be saturated with the vocabulary of ownership and financial discipline. They will talk about capital as a precious, finite resource. An agent, on the other hand, will use the language of empire, synergy, transformation, strategic initiatives, platform. Their language is abstract and designed to impress, not to inform. Step 2. Investigate the compensation. This is where the mask often comes off. The proxy statement is one of the most valuable and most ignored documents a company produces. Don't just look at the total pay. Look at the structure. Is the CEO's bonus tied to metrics that actually create shareholder value, like return on invested capital or free cash flow per share? Or is it tied to fuzzy metrics like revenue growth or, even worse, strategic milestones? Look for absurd perks. Does the CEO get personal use of the corporate jet? A lavish housing allowance? A country club membership? Remember Grandma's savings jar? Would you take money out of it to pay for your golf games? A steward wouldn't. An agent would see it as a rounding error. A particularly telling red flag is a CEO who is consistently selling large blocks of their own stock. An owner accumulates. An agent cashes out. Step 3. Examine the operational details. This requires some detective work. Read through industry publications, news articles, and employee reviews on sites like Glassdoor. Do employees complain about a bloated bureaucracy and wasteful spending, or do they talk about a lean, efficient culture? Look for the small things. Does the CEO fly commercial for business trips? It might seem trivial, but it sends a powerful message throughout the entire organization. David Neeleman, founder of JetBlue, was famous for flying on his own planes, sitting in a regular seat and helping the flight attendants clean up trash after the flight. That is the grandma's savings jar model in action. It demonstrates a commitment to the business at every level and an understanding that every dollar saved, even on a first-class ticket, belongs to the owners. Step 4. Assess their history of capital allocation. We will dive deeper into this later, but for now, look at their track record. When the company has had excess cash, what did they do with it? Did they make a string of overpriced acquisitions outside their circle of competence? Or did they patiently wait for opportunities, buy back their own stock when it was cheap, or return the cash to shareholders via dividends? A steward protects capital. An agent feels a compulsive need to spend it. By systematically working through these 4 steps, you move beyond the surface-level story and begin to build a true psychological profile of the management. You are looking for a pattern of behavior, a consistent demonstration that the CEO feels the weight of psychological ownership. You are looking for evidence that they see a jar of life savings, not a corporate slush fund. Now we must turn our attention to the opposite approach, the path that the vast majority of companies and investors follow. This is the path of the 99%, the world of the hired hand mentality. It is the default setting for modern corporate capitalism, and it is paved with the destruction of shareholder value. The hired hand, the agent CEO, operates from a fundamentally different psychological script than the owner-steward. Their primary motivation is not the long-term health of the enterprise, but the optimization of their own career and compensation. They are playing a different game, and if you're a shareholder, you are often little more than a pawn in that game. The hired hand focuses on metrics that are easily manipulated and look good on a resume. Revenue growth is a classic example. It's relatively easy to grow revenues. Buy another company, slash prices to gain market share, launch a dozen new initiatives. Whether any of this is profitable is a secondary concern. The headline number is, quote, and growth gets you positive press coverage and a bigger bonus. The owner-steward, by contrast, is obsessed with profitable growth, which is a much harder and slower path. They would rather have a smaller, more profitable company than a sprawling, marginally profitable empire. A perfect example of this destructive mentality was the reign of Ron Johnson at J.C. Penney. Hired from Apple, where he had great success building their retail stores, he was brought in as a superstar agent to transform the staid department store. He immediately set about spending lavishly. He tried to build an Apple-like store within a store concept, pouring hundreds of millions of dollars into store redesigns. He eliminated the discounts and coupons that were the lifeblood of J.C. Penney's customer base, a decision made without any meaningful testing. His focus was on creating a grand vision, on making his mark, on being the celebrated savior. He was acting as a hired hand with a huge budget. The result was one of the most swift and catastrophic collapses in retail history. Sales plummeted by over 25% in a single year, the stock price was annihilated, and thousands of people lost their jobs. Johnson was fired after just 17 months, walking away with a multi-million-dollar severance package. He had treated the company's capital not like grandma's savings jar, but like a pile of chips in a casino. He made a huge bet, lost everything, and the shareholders paid the price. This is the path of the 99%. Boards of directors, often composed of other CEOs, are complicit. They are drawn to charismatic visionaries and grand strategies. They reward revenue growth and bold moves because it justifies their own positions and feels more exciting than the slow, boring work of operational efficiency. Wall Street analysts enable this behavior, praising aggressive acquirers and punishing companies that are patiently holding cash. The entire ecosystem is geared towards the hired hand, not the steward. As an investor, your greatest challenge and your greatest opportunity is to deliberately step outside of this ecosystem. You must learn to see the charismatic, fast-talking CEO not as a savior, but as a potential red flag. You must learn to admire the boring, cost-obsessed CEO who talks in plain language about returns on capital. You are choosing to bet on the jockey, not just the horse, and the hired hand is a jockey who is often riding for his own glory, not for the finish line that benefits you. The difference between these two mindsets is not a philosophical abstraction, it manifests directly and powerfully on a company's financial statements. The direct financial connection between stewardship and success can be seen most clearly in a metric that Buffett has long championed: return on equity, or ROE. ROE is a simple but profound measure of a company's profitability. It is calculated by taking the company's net income and dividing it by its shareholders' equity. In simple terms, it answers the question: for every dollar of our own capital that we have invested in this business, how many cents of profit did we generate this year? A company with a consistent and high ROE is a compounding machine. It is a business that is exceptionally good at turning its own money into more money. A steward CEO is obsessed with this number, either explicitly or implicitly, because it is the ultimate measure of their performance as a manager of the owner's capital. Let's see how their owner's mindset directly inflates this crucial metric. First, consider the numerator of the equation: net income. A steward attacks the expense line with a vengeance. Every dollar saved on an unnecessary corporate retreat, a first-class flight, or a marble lobby flows directly down to the bottom line, increasing net income. They also avoid the value-destroying acquisitions that lead to massive write-offs and goodwill impairments, which devastate net income. They are focused on profitable sales, not just growth for growth's sake. This financial discipline creates a fatter, more resilient stream of earnings. Now consider the denominator: shareholders' equity. This represents the owner's stake in the business. A hired hand CEO often bloats the equity base. They might issue new shares to fund an overpriced acquisition, permanently diluting existing shareholders and increasing the denominator of the ROE calculation. They hold on to underperforming assets or failing divisions, trapping equity in unproductive parts of the business. A steward, on the other hand, is ruthless about managing the equity base. They are far more likely to use excess cash to buy back their own shares, especially when they are undervalued. A share buyback reduces the number of shares outstanding, which in turn reduces the shareholders' equity on the balance sheet. With a smaller denominator, the ROE calculation gets a powerful boost. They will also sell or shut down underperforming divisions, as Buffett did with the original Berkshire textile mills, freeing up that trapped equity to be deployed in more profitable ventures. So the steward works both sides of the equation. They maximize net income through relentless cost control and rational decision-making, and they minimize the equity base needed to produce that income. The result is a consistently high return on equity. This isn't just an accounting trick. It is the financial signature of a superior corporate culture and a management team that thinks like owners. A business that can consistently generate an ROE of 15% or more without using a lot of debt has a powerful engine for compounding shareholder wealth. It means that every dollar of profit that is retained and reinvested in the business is likely to earn that same high rate of return, creating a virtuous cycle of growth. This is the tangible, quantifiable outcome of finding a CEO who treats your money like it's their own. It is the end result of the grandma's savings jar model, a testament to the quiet power of stewardship over the loud promises of empire building. If the owner's mindset is the soul of a well-run company, then the physical environment is its body language. You can learn a tremendous amount about a company's priorities and culture long before you ever open an annual report, simply by looking at where and how they work. This brings us to the second great pillar of Buffett's CEO analysis: the physical manifestation of frugality. This is about reading the tangible clues, the non-financial data that signals a commitment to financial discipline. The most potent symbol, of course, is the corporate headquarters. For Buffett, the ideal headquarters is one that is almost an afterthought, functional, cheap, and as small as possible. The perfect foundational anecdote for this pillar is Berkshire Hathaway's own world headquarters. If you were to visit the executive offices of one of the largest and most successful companies in human history, you would not find a gleaming glass tower in Manhattan or a sprawling, resort-like campus in Silicon Valley. You would find a single floor in a modest office building in Omaha, Nebraska, the Kiewit Plaza. It has occupied the same space since 1962. There is no Berkshire Hathaway logo on the building. The furniture is functional, not designer. The decor is famously sparse. For decades, the entire global headquarters of an empire that controls hundreds of billions of dollars in assets has been run by a staff of a couple dozen people. There is no Department of Public Relations, no investor relations team, no chief strategy officer. Buffett answers his own phone. The message this sends is not subtle. It is a thunderous declaration of priorities. It says, we do not waste money on appearances. We do not believe that a fancy office makes us smarter. Every dollar we save on rent, on staff, and on overhead is a dollar that belongs to our shareholders, and we will guard it ferociously. This isn't just a personal quirk of Buffett's. It is a deliberate cultural signal that permeates every decision. He saw this same trait in another of his great CEO heroes, Tom Murphy of Capital Cities/ABC. Murphy was a legendary manager and capital allocator, and his obsession with costs was just as intense. Capital Cities headquarters was a famously drab affair, located in a less than prestigious part of New York. The offices were cramped and the furniture was second-hand. There were no corporate jets. Murphy and his partner Dan Burke were known for scrutinizing every line of an expense report. When they acquired the much larger and more glamorous ABC network in 1985, Wall Street was aghast. The buttoned-down, cost-cutting culture of Cap Cities was about to collide with the high-flying, high-spending world of network television. One of the first things Murphy did upon taking over was to eliminate the executive dining room at ABC's headquarters, a place of legend where network stars and powerful executives dined on fine food catered by a private chef. Murphy saw it for what it was, an unjustifiable expense, a symbol of a culture that had become disconnected from the reality of creating value. The limousine service for executives was canceled. The corporate jets were sold. The message was clear: the party is over. The focus now is on profitability, on efficiency, on converting revenues into cash flow for the owners. Murphy understood that the physical environment and the perks associated with it were not just expenses, they were a cultural virus. Lavishness begets lavishness. Once you justify a fancy headquarters, it becomes easier to justify first-class travel, then a corporate jet, then expensive corporate retreats. It creates an insulated bubble where executives lose touch with the value of a dollar. By contrast, a Spartan environment fosters a culture of discipline. When employees see the CEO flying coach and working from a modest office, it becomes much harder for a mid-level manager to justify an extravagant expense. Frugality, when modeled from the very top, becomes the institutional norm. Buffett and Murphy knew that the office carpet, the executive dining room, the corporate jet, these are not just line items on an expense report. They are the body language of the business, and they speak volumes about whether the management is focused on serving themselves or serving the shareholders. The powerful pull of a lavish corporate environment can be explained by a fascinating psychological principle known as the Diderot effect and its close cousin, conspicuous consumption. Understanding this is key to appreciating why a frugal headquarters is such a powerful defense against the erosion of shareholder value. The Diderot effect is named after the 18th century French philosopher Denis Diderot. In an essay, he described how receiving a beautiful new scarlet dressing gown as a gift ended up sending him into a spiral of debt. His new gown was so elegant that it made all his old possessions, his desk, his chairs, his tapestries, look shabby by comparison. He wrote, "My old robe was one with the other rags that surrounded me. Now everything is in disarray. There is no more coordination, no more unity, no more beauty." One by one, he replaced his old, perfectly functional items with new, more luxurious ones that lived up to the standard of his new gown. The purchase of a single luxury item had created a psychological need for a cascade of other luxury purchases. This is the Diderot effect. The introduction of a new, high-status possession can trigger a process of spiraling consumption. Now apply this to a corporate culture. A company decides to build a stunning new headquarters, an architectural marvel designed by a world-famous architect. This is the corporate equivalent of Diderot's scarlet dressing gown. Suddenly, the old office furniture looks dated. The company cafeteria seems inadequate. The CEO's company car, a modest sedan, no longer fits the image of a company housed in such a magnificent building. The Diderot effect kicks in. The company needs new designer furniture. It needs a gourmet cafeteria, run by a celebrity chef. It needs a fleet of luxury cars for its top executives. It needs a corporate jet to fly important clients into its impressive new home. Each expenditure becomes a justification for the next, creating a self-perpetuating culture of escalating costs. This is deeply connected to the idea of conspicuous consumption, a term coined by the economist Thorstein Veblen. He argued that people often consume goods and services not for their intrinsic utility, but as a public display of social status and wealth. A lavish headquarters is a form of corporate conspicuous consumption. It is a signal to the world, to competitors, and to potential employees that the company is successful and powerful. The problem is that this signaling is incredibly expensive, and the cost is borne entirely by the shareholders. A frugal leader like Buffett or Murphy instinctively understands the danger of the Diderot effect. They deliberately choose a shabby old dressing gown for their corporate headquarters. By keeping the central environment Spartan and functional, they break the cycle of escalating consumption before it can even begin. A modest headquarters sets a low baseline. It makes extravagant spending on other things look jarring and out of place. It short-circuits the psychological pressure to have every aspect of the company live up to a luxurious standard. This is a profound act of psychological engineering. It's not just about saving money on rent. It's about inoculating the entire corporate culture against the virus of conspicuous consumption. It creates an environment where the focus remains on substance, on the actual business of creating value, rather than on the expensive and distracting theater of corporate status. When you see a company with a modest headquarters, you are seeing a management team that has made a conscious decision to reject the Diderot effect and prioritize shareholder value over corporate vanity. As an investor, you don't need to physically visit a company's office to assess its commitment to frugality. You can conduct a powerful corporate campus audit from your own desk. This mental model is a practical checklist to help you read the physical body language of a business and spot the red flags of wasteful spending. It's a critical component of a thorough CEO analysis and investment checklist. Step 1. The Google Maps reconnaissance. This is the simplest and most telling first step. Type the address of the company's world headquarters into Google Maps and switch to satellite and street view. What do you see? Is it a sprawling, manicured campus in an expensive suburb, complete with ponds, sculptures, and athletic fields? Or is it an anonymous floor in a downtown office building, or a functional-looking building in a low-cost industrial park? Compare the headquarters of a company like Costco, famously located in a nondescript building next to one of its own warehouses, to the lavish headquarters of a company known for its struggles, and the contrast will be illuminating. Look for signs of excess: fountains, elaborate architecture, vast empty plazas. These are all funded by shareholder money. Step 2. The SG&A expense deep dive. SG&A stands for Selling, General, and Administrative Expenses. This line item on the income statement is the catch-all for corporate overhead, including headquarters rent, utilities, and executive salaries. A good analyst doesn't just look at the number in a single year. They look at it as a percentage of revenue, and they track it over a decade. Is the percentage consistently low and stable, or is it creeping up over time? Compare it to the company's closest competitors. A company with a persistently lower SG&A to revenue ratio has a powerful competitive advantage. It's a sign of a lean, efficient corporate culture. If you see a sudden spike in SG&A, dig into the company's filings to find out why. Often, it's connected to a move to a new, more expensive headquarters. Step 3. The Glassdoor and News Archive search. Employees and journalists often see what investors don't. Go to employee review sites and search for keywords like perks, office, spending, and culture. Do employees rave about the free food, the nap pods, and the extravagant holiday parties? Or do they talk about a culture focused on getting the job done without a lot of frills? Be careful here. A good work environment is important, but there is a line between providing necessary benefits and creating a lavish adult playground. Next, search news archives for articles about the company's spending. Search for terms like company name corporate jet or company name new headquarters. You might be surprised at what you find. The purchase of a new Gulfstream G650 is often celebrated in the aviation press, but should be seen as a massive red flag for an investor. Step 4. Scrutinize the annual report's imagery. This is a subtle but powerful clue. Open the company's latest annual report. Is it a glossy, art house production filled with dramatic, airbrushed photos of executives posing in front of their shiny new headquarters? Or is it a simple, text-focused document, perhaps even printed on cheap paper, that gets straight to the financial facts? Berkshire Hathaway's annual report is famously plain, with no photos, just dense text and financial data. The message is clear: we spend our time running the business, not on fancy graphic design. A company that spends a fortune to make its annual report look good is signaling that image is more important than substance. By using this 4-step audit, you can build a mosaic of evidence. You are looking for a pattern of behavior that points towards a culture of financial discipline. A modest headquarters on Google Maps, a low and stable SG&A ratio, a lack of news about extravagant perks, and a no-nonsense annual report. Together, these clues paint a powerful picture of a management team that respects shareholder capital. To fully appreciate the wisdom of the frugal path, we must examine its antithesis, the Palace of Versailles approach to corporate architecture. This is the path of the 99%, where the headquarters is not a place of work but a monument to the CEO's ego and the company's perceived prestige. This approach is a siren song for boards and executives, and it almost always ends in the destruction of shareholder value. The historical Palace of Versailles in France is the ultimate symbol of centralized power and out of touch, extravagant spending by a monarchy that was growing increasingly disconnected from its people. A corporate headquarters built in this image serves the exact same function. It is designed to awe and intimidate, to project an image of unassailable success, and to insulate its inhabitants, the senior executives, from the mundane realities of the business and the concerns of its owners. One of the most infamous modern examples was the headquarters of Tyco International, under CEO Dennis Kozlowski. In the late 1990s and early 2000s, Kozlowski turned Tyco into a symbol of corporate excess. The company's headquarters in New York was a lavishly decorated apartment on Fifth Avenue, purchased and decorated with millions of dollars of company money. It included items like a $6,000 shower curtain and a $15,000 dog umbrella stand. This was not a functional office, it was a CEO's private palace funded by shareholders. It was the ultimate red flag, a physical manifestation of a corrupt corporate culture that viewed the company's assets as the personal property of the chief executive. The subsequent scandal and collapse of Tyco's stock price was a brutal lesson in what happens when the Palace of Versailles mentality takes root. Another classic example comes from the dot-com bubble. Companies that had never turned a profit were spending fortunes on cool office spaces, with slides, basketball courts, and celebrity chefs. They were building palaces on a foundation of sand. The company Boo.com became a legendary case study. It burned through over $135 million of venture capital in 18 months, with a significant portion going to opulent offices in London and New York. The focus was on creating a glamorous image, not on building a sustainable business model. When the bubble burst, these companies collapsed overnight, leaving behind nothing but expensive office furniture and worthless stock certificates. The psychological trap here is that these projects are so seductive. A board of directors is easily persuaded that a new, world-class headquarters is necessary to attract top talent or to reflect our status as an industry leader. The CEO gets to play the role of a modern-day pharaoh, building a pyramid to their own legacy. The architectural and construction firms involved make a fortune. The media celebrates the bold new design. In this chorus of approval, the voice of the shareholder is drowned out. No one stops to ask the simple, brutal question that a Buffett or a Murphy would ask: what is the return on investment of this marble lobby? The answer, of course, is zero. In fact, the return is negative. Not only does it drain capital that could have been used for productive purposes, but it also seeds the culture with the Diderot effect, leading to a permanent increase in the company's overhead and a decrease in its future profitability. As an investor, learning to see a magnificent new corporate headquarters not as a sign of success, but as a potential harbinger of doom, is one of the most valuable perspective shifts you can make. The choice between a Spartan office and a corporate palace has a direct, measurable, and profound impact on a company's financial health. The direct financial connection can be seen most clearly in the company's operating margins. An operating margin is a key profitability ratio that tells you what percentage of every dollar of revenue is left over after paying for the costs of running the business, but before paying interest and taxes. A higher operating margin means a more profitable and efficient company. A culture of frugality is a machine for generating and protecting high operating margins. Let's create a hypothetical but realistic comparison of two companies in the same industry. Company A, Acme Austerity, is run by a frugal, owner-oriented CEO. Company B, Baroque Buildings, is run by an empire builder obsessed with image. Both companies generate $1 billion in annual revenue. At Acme Austerity, the culture of frugality is deeply ingrained. Their headquarters is a leased space in a low-cost suburban office park. They have no corporate jet. Travel is done in coach. There are no lavish executive retreats. As a result, their selling, general, and administrative (SG&A) expenses, which capture all this corporate overhead, run at a lean 10% of revenue, or $100 million. At Baroque Buildings, the picture is very different. They have a massive, company-owned headquarters campus in a high-cost city. They operate a fleet of 3 corporate jets. Their top executives enjoy a host of expensive perks. Their SG&A expenses run at 15% of revenue, or $150 million. On the surface, a 5% difference in SG&A might not seem dramatic, but let's look at the impact on operating income. Let's assume both companies have the same cost of goods sold at $600 million. Acme Austerity's operating income is revenue, $1 billion, minus COGS, $600 million, minus SG&A, $100 million, which equals $300 million. Their operating margin is a very healthy 30%. Baroque Buildings' operating income is revenue, $1 billion, minus COGS, $600 million, minus SG&A, $150 million, which equals $250 million. Their operating margin is 25%. That extra $50 million spent on the corporate palace and its associated perks comes directly out of the pockets of the shareholders. Acme Austerity has an extra $50 million in cash every single year to reinvest in the business, develop new products, pay down debt, buy back stock, or pay dividends. Baroque Buildings has lit that $50 million on fire to maintain its image. Now, let's compound this over a decade. Assuming no growth, for simplicity, Acme Austerity will have generated $500 million more in operating income than Baroque Buildings. That is, $500 million of shareholder value created or destroyed based on the philosophy of the CEO and the culture they instill. In reality, the situation is even worse for Baroque Buildings. Their lower profitability gives them less flexibility. During an economic downturn or a price war with a competitor, their high-cost structure becomes an anchor that can sink the entire ship. Acme Austerity, with its fat margins, can afford to lower prices to gain market share, invest in new technology while competitors are struggling, and emerge from the downturn stronger than ever. Their frugality isn't just a defense, it's a powerful offensive weapon. As an investor performing fundamental analysis, scrutinizing the cost structure is not a boring accounting exercise. It is a window into the soul of the company. A lean cost structure, evidenced by a modest physical presence, is a powerful indicator of management quality and a predictor of long-term, sustainable portfolio growth. We've explored the mindset of the owner and the physical evidence of their discipline. Now we must turn to the most critical function of any CEO, the nexus where frugality and intelligence combine to create staggering wealth, capital allocation. This is the third and perhaps most important pillar of Buffett's analysis. Frugality in office furniture is a good sign, but frugality in multi-billion-dollar decisions is where legends are made. Capital allocation is simply the process of deciding what to do with the company's profits. A CEO is a capital allocator, and their skill in this domain will ultimately determine the long-term return for shareholders. A frugal, owner-oriented leader views this as a sacred duty. They understand that the cash generated by the business belongs to the shareholders, and their job is to deploy it in the most rational, value-enhancing way possible. They are masters of the art of saying no. The foundational anecdote for this pillar is one of the most painful but important decisions in Buffett's career, the decision to shut down Berkshire Hathaway's original textile business. When Buffett took control of Berkshire Hathaway in 1965, it was a struggling textile manufacturer in New Bedford, Massachusetts. For 2 decades, he and his partner, Charlie Munger, wrestled with the business. They ran it as efficiently as possible, investing in new equipment and managing costs ruthlessly. But they were fighting a losing battle against a tide of foreign competition with much lower labor costs. The business was generating some cash, but the returns on any new capital invested in it were pitiful. It was a classic cigar butt investment, a terrible business bought at a cheap price. Many CEOs in this situation would have fallen into a common trap. They would have continued to pour money into the textile operations, driven by a sense of loyalty to the employees, a desire to turn things around, or a simple inability to admit defeat. They would have thrown good money after bad. Buffett, however, took a colder, more rational approach. He treated the cash generated by the textile mills not as, quote, textile money, but as shareholder money. His loyalty was to the owners of the capital, not to the original business that generated it, so he began a process of capital reallocation. He took the meager profits from the textile business and, instead of reinvesting them in new looms, he used them to buy stakes in wonderful businesses like See's Candies and the Washington Post. He was starving the bad business to feed the good ones. Finally, in 1985, he made the final, agonizing decision. He shut down the last of the textile operations for good. It was a painful choice. It meant job losses for a loyal workforce in a town that depended on the mills. Buffett himself said it was one of the toughest things he ever had to do. But from a capital allocation perspective, it was the only correct move. To continue operating the mills would have been to consciously destroy shareholder capital. His duty as a steward was to protect that capital, even if it meant making an unpopular and emotionally difficult decision. This story is the epitome of disciplined capital allocation. It demonstrates a commitment to rationality over sentiment. It shows a leader who understands that his job is not to preserve the past, but to build a profitable future. The frugal mindset, applied to capital allocation, means saying no to projects, divisions, and even entire businesses that cannot generate an adequate return on the capital they employ. It means having the discipline to walk away from a bad hand, take your remaining chips, and move to a better table. That single act of shutting down the textile business and redirecting that capital flow over the preceding 2 decades was the foundational decision that transformed Berkshire Hathaway from a dying New England textile company into the global powerhouse it is today. It was a masterclass in capital allocation as a sacred duty. Why is this rational act of reallocating capital so difficult for most leaders? Why do so many CEOs continue to fund failing projects and money-losing divisions? The answer lies in 2 powerful and closely related cognitive biases: the sunk cost fallacy and commitment bias. A mastery of frugal leadership requires a conscious and deliberate fight against these deep-seated psychological traps. The sunk cost fallacy is our tendency to continue with an endeavor if we have already invested time, money, or effort into it, even when it's clear that the current costs outweigh the likely benefits. The past investment, the sunk cost, becomes a psychological justification for future investment, leading to a disastrous escalation of commitment. Imagine you've spent $60 on a non-refundable ticket to a concert. On the night of the show, a blizzard hits. The drive is dangerous, and you've also come down with the flu. Rationally, you should stay home. The $60 is gone whether you go or not. It's a sunk cost. The rational decision is to evaluate the current situation, a dangerous drive and a miserable night out, versus a safe, warm night in. Yet, many people will force themselves to go, thinking, I can't let the $60 go to waste. They are making a bad decision in the present to justify a past one. Now apply this to a multi-billion-dollar corporation. A CEO champions a major new project, perhaps a new factory in a foreign country. The company spends $1 billion building it. 2 years in, it becomes clear that the market has changed, the assumptions were wrong, and the factory will never be profitable. The rational move, the Buffett move, is to shut it down, sell it for scrap if necessary, and cut the losses. The sunk cost of the $1 billion is irrelevant to the future decision, but the CEO who launched the project is now trapped. They are psychologically invested. To shut it down would be to admit a massive public failure. So they double down. We just need to invest another $500 million to get it right, they argue. They are letting the sunk cost dictate their future actions. This is reinforced by commitment bias, also known as escalation of commitment. We have a deep-seated need to appear consistent in our beliefs and actions. Once we have publicly committed to a course of action, we are highly resistant to changing our minds, even in the face of overwhelming evidence that we are wrong. The CEO has told the board, the analysts, and the media that this new factory is the future of the company. Their personal credibility and reputation are now tied to the project's success. Backing down feels like a personal failure, so they continue to pour resources into the fire, desperately trying to prove their initial decision was correct. A frugal, owner-oriented capital allocator has developed the mental fortitude to override these biases. They achieve this through a relentless focus on a concept called opportunity cost. They constantly ask, what is the best possible use for the next dollar of our capital? They know that every dollar spent propping up a failing division is a dollar that cannot be spent buying back undervalued stock, investing in a highly profitable new product line, or making a smart acquisition. They reframe the decision. It's not about admitting failure by shutting down the factory. It's about seizing a better opportunity by reallocating that capital elsewhere. This depersonalizes the decision. It shifts the focus from the past to the future. It replaces ego and emotion with cold, forward-looking rationality. This ability to ignore sunk costs and remain intellectually flexible is an incredibly rare and valuable trait in a leader. It is the psychological engine that drives superior capital allocation and, ultimately, superior long-term returns. To operationalize this way of thinking, investors need a structured framework for evaluating a CEO's capital allocation decisions. Let's call this mental model the 4 chambers of the capital heart. Imagine the company's annual profit is a flow of life-giving blood. The CEO is the heart, responsible for pumping that blood to the areas where it will do the most good for the long-term health of the organism. There are only 4 places that blood can go. A skilled CEO knows the right sequence and the right proportion for each. Chamber 1. Reinvest in the core business. This is the first and best option, but only if the business can generate high returns on that additional invested capital. A company with a strong competitive moat and plenty of room to grow should be reinvesting every penny it can back into its operations, opening new stores, building new factories, funding R&D. The key question for an investor to ask is, what is the historical return on tangible invested capital for this business? If a company can consistently earn 20 cents on every new dollar it reinvests, then reinvesting is a fantastic use of capital. A frugal allocator insists on this high bar. An empire builder will reinvest capital even if the returns are mediocre, simply to grow the size of the business. Chamber 2. Make sensible, value-accretive acquisitions. If the core business cannot absorb all the cash flow at high rates of return, the next best option may be to acquire other businesses. The key words here are sensible and value-accretive. A disciplined, frugal allocator has a strict set of criteria. They only buy businesses they understand. They wait for a fair or even cheap price, and they look for acquisitions that fit strategically and culturally. They are willing to sit on cash for years, waiting for the right pitch. Their default answer to a potential deal is no. For an investor, the checklist question is, what is the company's track record with acquisitions? Have past deals generated good returns, or have they been followed by write-offs and disappointment? Chamber 3. Repurchase shares. If there are no high-return opportunities for reinvestment and no sensible acquisitions available at a fair price, the next chamber is to buy back the company's own stock. But again, there is a crucial caveat: only when the stock is trading below its intrinsic value. A frugal allocator sees their own stock as just another investment. If it's cheap, it's a great buy. If it's expensive, buying it back would destroy value. Many CEOs buy back shares at any price, often to offset the dilution from their own stock option grants, or to artificially boost earnings per share. This is poor capital allocation. The investor's question: does the company buy back shares opportunistically when the stock is down, or do they buy back shares consistently, even at market highs? Chamber 4. Pay a dividend. If all of the above options are exhausted, the business can't reinvest the cash at high rates, there are no good acquisitions, and the stock is too expensive to buy back, then the only remaining option for a disciplined allocator is to return the capital to the owners. This is the function of a dividend. It is an admission by management that they cannot find a better use for the shareholders' money, so they are giving it back. It is an act of ultimate stewardship. The investor must ask, is the dividend sustainable, and does it represent a rational decision after considering all other options? A great capital allocator is constantly evaluating these 4 chambers. They are unsentimental. They follow the returns. A poor capital allocator, the typical hired hand, gets this all wrong. They throw money at low-return internal projects, Chamber 1. They get addicted to making exciting but overpriced deals, Chamber 2. They buy back stock at any price to manipulate earnings, Chamber 3. And they often avoid paying dividends because it reduces the size of the empire they control. Using the 4 chambers model provides a powerful lens through which to judge the true quality of a management team. The path of the 99% when it comes to capital allocation is a story of compulsive action and value destruction. It is the path of diversification, a term famously coined by Peter Lynch to describe the tendency of companies to expand into areas they don't understand, often through disastrously overpriced acquisitions. This behavior is the polar opposite of the patient, disciplined approach of a frugal steward. The diversification spree is driven by a cocktail of institutional pressures and psychological biases. The CEO is often bored with the core business. It's mature, it's predictable, and running it efficiently doesn't generate exciting headlines. The CEO and the board feel a pressure to do something with the company's cash. Sitting on a growing pile of cash is seen as conservative and uninspired. Wall Street investment bankers who make enormous fees from deal-making are constantly whispering in the CEO's ear, presenting strategic and transformative acquisition opportunities. The CEO's ego gets involved. A big, bold acquisition gets them on the cover of business magazines. It dramatically increases the size of the company they control, which often leads to a higher salary and bonus. The logic is simple: bigger is better. The most infamous example in corporate history is the 2000 merger of America Online, AOL, and Time Warner. At the peak of the dot-com bubble, AOL, the high-flying internet company, acquired Time Warner, the old media giant, for a staggering $164 billion. It was hailed as a visionary deal that would define the future of media and the Internet. The leaders of both companies, particularly Steve Case of AOL and Gerald Levin of Time Warner, were celebrated as geniuses. They were the ultimate empire builders. But the reality was a catastrophic clash of cultures and a complete failure to realize any of the promised synergies. AOL's business model was already beginning to crumble as the dial-up era ended. Time Warner's divisions had no idea how to integrate with the Internet company. The deal was a monument to hubris and a textbook case of paying a ludicrously high price for a company in a completely different industry. The aftermath was brutal. Within 2 years, the combined company was forced to take a goodwill impairment charge of nearly $100 billion, at the time the largest in corporate history. This was an accounting admission that they had lit $100 billion of shareholder money on fire. The stock price collapsed, wiping out hundreds of billions in market value. The architects of the deal eventually left in disgrace. This is the end result of the diversification path. It is what happens when capital allocation is driven by ego, excitement, and a desire to build an empire, rather than by a sober, rational analysis of value. The frugal allocator, the steward, looks at a deal like AOL Time Warner and feels a sense of revulsion. It is an offense against the sacred duty of protecting shareholder capital. They would rather sit on cash for a decade than participate in such a value-destroying spectacle. As an investor, your ability to distinguish between a CEO who is a patient, skilled capital allocator and one who is an impulsive empire builder is one of the most important judgments you will ever make. The former will make you rich over the long term. The latter will almost certainly cost you dearly. The financial consequences of great versus poor capital allocation are monumental. They are most clearly visible in the generation of free cash flow, FCF, and the resulting calculation of a company's intrinsic value. This is the direct financial connection that links a CEO's discipline to your long-term portfolio growth. Free cash flow is the cash a company generates after accounting for the capital expenditures necessary to maintain and expand its asset base. It is the pool of cash that is truly free to be used for the benefit of shareholders, to pay down debt, make acquisitions, buy back stock, or pay dividends. It is the ultimate measure of a company's financial health. A master capital allocator, guided by a frugal mindset, is a machine for maximizing long-term free cash flow. Let's see how. A disciplined allocator is ruthless about investing only in high-return projects. This means they generate more operating cash flow for every dollar of capital they invest. They avoid the low-return projects that consume cash and generate paltry profits. They also manage capital expenditures wisely. They don't overspend on shiny new equipment or unnecessary expansions. This discipline results in a higher conversion of net income into free cash flow. A poor capital allocator, the empire builder, destroys FCF. They make overpriced acquisitions that drain the company's cash reserves. These acquisitions often come with their own heavy capital expenditure requirements, further depleting FCF. The synergies they promise rarely materialize, so the expected boost to operating cash flow never arrives. They are pouring cash into a black hole. This difference in FCF generation has a direct and dramatic impact on the intrinsic value of the business. The most common method for valuing a business is the discounted cash flow, DCF model. In a DCF analysis, you project a company's future free cash flows over a long period, say 10 or 20 years, and then discount them back to the present day to arrive at a single number representing the company's true worth. The two most important inputs in a DCF model are the growth rate of future free cash flows and the discount rate used. A company run by a skilled capital allocator will have a much higher projected growth rate of FCF. Their disciplined reinvestment in high-return projects and their avoidance of value-destroying deals means the stream of cash they generate for owners will grow faster and more reliably over time. A company run by an empire builder will have a lower, more erratic FCF growth rate, punctuated by the massive cash drains of bad acquisitions. So if you were to run a DCF analysis on two otherwise identical companies, one led by a steward and one by an agent, the steward-led company would have a significantly higher calculated intrinsic value. This is not financial wizardry. It is simple logic. A management team that is better at turning profits into cash for the owners is running a more valuable business. This is the ultimate financial payoff of Buffett's focus on frugal leadership. He is looking for CEOs whose actions will result in a superior long-term stream of free cash flow. He knows that over time, a company's stock price will inevitably track its intrinsic value, and intrinsic value is a function of free cash flow. By focusing on the quality and discipline of the capital allocator, he is stacking the odds dramatically in his favor, ensuring that the businesses he owns are not just growing, but are growing in a way that creates real, tangible cash value for him as an owner. Now we must confront the enemy directly. We must dedicate an entire chapter to understanding the mindset and methods of the antithesis of the frugal steward, the empire-building CEO. This is the fourth pillar of our analysis. To successfully avoid a trap, you must first understand its design and the bait it uses. Ego is the enemy of equity, and the empire builder is ego personified. Their story is a cautionary tale, a field guide to the red flags that precede financial disaster. To truly paint this picture, we can look to the epic saga of R.J.R. Nabisco in the 1980s, immortalized in the book Barbarians at the Gate. The company's CEO, F. Ross Johnson, was the archetypal empire builder. He was charismatic, charming, and utterly captivated by the perks and prestige of his position. Under his leadership, R.J.R. Nabisco became a symbol of corporate excess. The company operated a fleet of corporate jets so large it was nicknamed the RJR Air Force. Johnson and his top executives used these planes like personal taxis, flying to golf tournaments and vacation homes, often with their dogs, who had their own frequent flyer accounts. The company sponsored lavish sporting events and paid celebrities enormous sums to endorse its products. There was a hangar full of planes, a hangar full of pilots, and a hangar full of flight attendants, all on the corporate payroll. The headquarters was a temple of opulence. Johnson's personal spending was legendary, all of it billed back to the company, and, by extension, its shareholders. He was not a steward of capital. He was a king ruling over a corporate kingdom, and he used the treasury to fund his lavish lifestyle. The business itself was a solid, cash-generating machine built on tobacco and food brands. But Johnson was not content to simply run it efficiently. He was an empire builder. He pursued a series of ill-fated acquisitions and product launches, including the infamous smokeless cigarette, a project that burned through hundreds of millions of dollars before being declared a colossal failure. The focus was always on the next big exciting thing, not on the disciplined day-to-day work of maximizing profitability. The culmination of this ego-driven culture was Johnson's attempt to take the company private in a leveraged buyout. His initial proposal was so skewed in favor of himself and his management team at the expense of the shareholders that it triggered a massive bidding war for the company. The ensuing battle exposed the depth of the corporate rot and the shocking disconnect between the management's priorities and the owners' interests. The story of F. Ross Johnson and R.J.R. Nabisco is the perfect foundational anecdote for the empire builder's trap because it contains all the classic elements: a focus on perks over performance, a cult of personality around a charismatic CEO, a series of wasteful and ego-driven strategic moves, and an ultimate disregard for the rightful owners of the business. It is a vivid illustration of what happens when a hired hand starts to believe he is a king. For an investor, studying stories like this is not just entertainment, it is essential training in pattern recognition. The red flags that were flying all over R.J.R. Nabisco in the 1980s are the same red flags that fly over poorly managed companies today. Learning to spot them is a critical survival skill. What drives a leader like F. Ross Johnson? What is the psychological engine behind the empire builder? The answer lies in a toxic combination of two well-documented cognitive biases: the overconfidence bias, and the psychological traits associated with narcissistic leadership. Understanding this personality profile is crucial for any serious CEO analysis. The overconfidence bias is the tendency for people to have excessive faith in their own knowledge, abilities, and judgments. We all suffer from it to some degree, but in a powerful CEO, it can be amplified to a dangerous level. A leader who has enjoyed a string of successes starts to believe they are infallible. They attribute all their wins to their own genius and all their losses to bad luck or external factors. This is the God complex. The overconfident CEO believes their gut instinct is more reliable than data and analysis. They believe they can successfully run any business, regardless of their experience in the industry. This is what leads them down the path of diversification. They think their Midas touch will allow them to turn around a struggling company in a completely unrelated field. They overpay for acquisitions because they are supremely confident that their brilliant management will create enough value to justify the price. They are, in essence, gambling with shareholder money, convinced that they can't lose. This overconfidence is often intertwined with narcissistic personality traits. A narcissistic leader is characterized by an inflated sense of self-importance, a deep need for excessive attention and admiration, and a lack of empathy for others. In a corporate setting, this translates into a CEO who is obsessed with their public image. They crave the adulation that comes with being on magazine covers and being lauded as a visionary. They build the Palace of Versailles headquarters as a monument to their own greatness. They pursue massive, headline-grabbing acquisitions not for their strategic merit, but for the attention and prestige they generate. Because they lack empathy, they view shareholders not as partners or owners, but as a faceless audience for their performance. Employees are seen as tools to achieve their personal ambitions. The combination is lethal. The narcissism creates the desire for a grand empire, and the overconfidence provides the self-justification to pursue it recklessly. This type of leader surrounds themselves with sycophants who will not challenge their ideas, creating an echo chamber that reinforces their biases. Anyone who questions the leader's grand vision is seen as disloyal or lacking in ambition and is quickly pushed out. The result is a corporate culture where rational analysis is replaced by fealty to the leader's ego. The company becomes an extension of the CEO's personality, and its resources are deployed to serve their psychological needs, not the financial interests of the owners. Identifying this psychological profile is one of the most important qualitative tasks for an investor. It requires looking beyond the numbers and paying close attention to the CEO's language, behavior, and the culture they create around them. To help investors systematically identify these dangerous leaders, we can create a qualitative mental model called the ego-to-equity ratio. This isn't a real financial ratio, but a powerful checklist for spotting the warning signs of an empire builder. Your goal is to score a CEO on a scale of 1 to 10 across several categories. A high aggregate score is a major red flag, suggesting a dangerous imbalance where the CEO's ego is taking precedence over the creation of shareholder equity. Here are the components of the audit. 1. The annual report test. How prominently is the CEO featured? Is their photograph on the cover? Are there multiple, glossy photos of them inside? A steward-led report like Berkshire's focuses on the business and the numbers. An ego-driven report often looks more like a celebrity photo shoot. Also, read the CEO's letter. Is it filled with the royal I or the collective we? Does it take personal credit for successes while blaming external factors for failures? High score for high self-promotion. 2. The media presence score. How much time does the CEO spend cultivating their personal brand? Are they constantly on television, giving keynote speeches at conferences, and being profiled in magazines? While some media presence is necessary, an excessive focus on it suggests a leader who is more interested in being a celebrity than a manager. A frugal steward is often reclusive and media shy, preferring to let the company's results speak for themselves. Score higher for CEOs who seem to be everywhere. 3. The transformative deal index. Analyze the CEO's language around acquisitions and strategy. Do they talk about bolt-on acquisitions and organic growth? Or do they use grandiose terms like transformative, game-changing, and paradigm-shifting? The latter is the language of empire building and ego. It often prefaces a massive, risky bet that has a high probability of destroying value. 4. The edifice complex. This ties back to our earlier discussion on headquarters. Is the CEO's name on any of the company's buildings? Have they spearheaded the construction of a lavish new headquarters or a personal vanity project? The desire to build physical monuments is a classic sign of an ego-driven leader seeking a tangible legacy. 5. The compensation structure. As discussed before, look beyond the headline number. Is the compensation package heavily skewed towards rewarding sheer size, revenue growth, market share, number of employees, rather than profitability and returns on capital? A compensation plan that rewards empire building will inevitably produce an empire builder. By running a target CEO through this 5-point checklist, you can develop a much clearer picture of their underlying motivations. This is a critical part of the management quality component of any investment thesis. It helps you move beyond the superficial charm and charisma that often mask a dangerous level of ego. A low score on the ego-to-equity ratio is a strong indicator that you have found a leader who is more focused on building wealth for their shareholders than on building a monument to themselves. This entire chapter has been about the antithesis of frugal leadership, but this specific section must focus on a crucial question: why do so many people fall for it? Why do investors, boards, and the media repeatedly get taken in by empire-building CEOs? This is the rationalization of the 99%. Understanding this mass delusion is key to being able to resist it. The first reason is the powerful allure of a good story. Human beings are wired for narrative. A charismatic CEO with a bold, exciting vision for the future tells a much more compelling story than a quiet, frugal CEO who talks about incremental improvements in operating efficiency. The empire builder's story is one of conquest, transformation, and destiny. It's exciting. The steward's story is one of patience, discipline, and compounding. It's boring. In a world saturated with information, the exciting story cuts through the noise and captures the imagination. Investors get caught up in the narrative and forget to do the hard analytical work. The second reason is the worship of charisma. We have a deep-seated bias to associate confidence and eloquence with competence. A CEO who is a fantastic public speaker and presents a slick, optimistic vision is often perceived as being a more capable leader, even if their operational track record is poor. The quiet, analytical, and perhaps socially awkward CEO is often underestimated. Boards of directors are particularly susceptible to this, as they are often chosen for their own pedigrees and public profiles and are naturally drawn to candidates who fit the same mold. The third factor is the institutional imperative, a concept Buffett often discusses. This is the tendency for organizations to mindlessly imitate the behavior of their peers, regardless of whether it makes sense. If the leading company in an industry makes a big acquisition, all the other companies in the sector feel immense pressure to do the same, lest they be seen as, quote, falling behind. This creates a cascade of bad decisions, as companies rush to overpay for assets simply to keep up appearances. Analysts and the financial media pour fuel on this fire, praising the bold deal-makers and questioning the conservative managers who are sitting on the sidelines. To resist this tide is to risk looking foolish in the short term. The final rationalization is a misunderstanding of what creates long-term value. Many investors are focused on short-term stock price movements. An announcement of a big acquisition often causes a company's stock to pop, at least initially. It creates excitement and trading volume. This short-term reward reinforces the idea that deal-making is a good thing. The long, slow process of value destruction through poor integration, culture clashes, and overpayment happens over years and is often obscured by a dozen other factors. The immediate, positive feedback of the exciting announcement overwhelms the slow, negative reality that follows. To be a successful long-term investor, you must actively fight these rationalizations. You must train yourself to be suspicious of great stories, to value competence over charisma, to ignore the institutional imperative, and to focus on the long-term fundamentals of value creation rather than short-term market sentiment. You must be willing to be bored. The path of the frugal steward is rarely exciting, but it is the one that has been proven, time and again, to lead to extraordinary portfolio growth. The financial destruction wrought by empire builders manifests in two particularly ugly ways on a company's balance sheet and income statement: shareholder dilution and goodwill impairment. Understanding these two concepts is essential for appreciating the tangible cost of ego-driven management. Shareholder dilution occurs when a company issues new shares of stock. This can happen for various reasons, but a common one for an empire builder is to fund an acquisition. Let's say a company's stock is trading at $100 per share, and they want to buy another company for $10 billion. Instead of paying with cash, they decide to issue 100 million new shares and give them to the shareholders of the target company. Before the deal, let's imagine the acquiring company had 400 million shares outstanding. After the deal, it now has 500 million shares outstanding. As an existing shareholder, you used to own a certain percentage of the company. Now your slice of the pie has gotten smaller, your ownership has been diluted. Dilution is not always bad. If the asset being acquired is truly worth more than the shares being issued, it can be a good deal. But the empire builder, driven by the desire to do a deal at any cost, almost always overpays. They are effectively trading their own valuable stock for an overpriced asset. This is a direct transfer of wealth away from their existing shareholders. The second, and often more dramatic financial consequence, is goodwill impairment. Goodwill is an intangible asset that gets created on the balance sheet after an acquisition. It represents the premium the acquiring company paid over the fair market value of the target's identifiable assets. For example, if a company has tangible assets, factories, cash, inventory worth $8 billion, but an acquirer pays $10 billion for it, the extra $2 billion is recorded on the acquirer's balance sheet as goodwill. It's a plug number that represents things like brand reputation, customer relationships, etc. The empire builder who overpays for a transformative deal will load up their balance sheet with a mountain of goodwill. The problem is that accounting rules require companies to periodically test whether that goodwill is still worth what they paid for it. If the acquired business underperforms and fails to generate the expected cash flows, which is often the case with overpriced, poorly integrated acquisitions, the company must impair or write down the value of the goodwill. The goodwill impairment charge is a non-cash expense that flows through the income statement, often resulting in a massive reported loss for the quarter. The infamous $99 billion impairment charge taken by AOL Time Warner is the classic example. This is not just an accounting entry. A goodwill impairment is a formal, public admission by the management team that they made a terrible capital allocation decision. It is a confession that they overpaid for an asset and have permanently destroyed a massive amount of shareholder capital. When you see a company taking large and recurring goodwill impairment charges, you are looking at the financial wreckage left in the wake of an empire builder. It is the tombstone of a bad acquisition, a direct and quantifiable measure of the cost of a CEO's ego. A disciplined, frugal allocator, by contrast, is allergic to overpaying. They would rather do no deals than a bad deal. As a result, their balance sheets are typically cleaner, with far less goodwill, and they rarely suffer the embarrassment and value destruction of a major impairment charge. We arrive now at our fifth and final pillar, the culmination of this entire philosophy. Frugality is not merely a defensive tactic for saving money. In the hands of a great leader, it becomes a powerful offensive weapon. A deeply ingrained culture of cost consciousness can evolve into a durable, almost unbreachable competitive moat. It is the unbeatable advantage of low costs, the force that allows a company not just to survive, but to dominate its industry. The foundational anecdotes for this pillar come from two of Buffett's most successful long-term investments, Geico and Costco. These two companies, operating in vastly different industries, share a common soul. Their entire business models are built upon a fanatical, cult-like devotion to operational efficiency and passing the savings on to the customer. Let's start with Geico. Before Geico, the auto insurance industry was dominated by companies that used a massive network of independent agents to sell policies. These agents were a huge layer of cost, taking a significant commission on every policy they sold. Geico's founder, Leo Goodwin, had a brilliant insight. What if you could bypass the agents and sell directly to a targeted, low-risk group of customers, like government employees? This direct-to-consumer model was a revolutionary act of frugality. By eliminating the agent commissions, Geico could offer significantly lower premiums than its competitors. This low-cost structure became its identity and its moat. When Buffett's Berkshire Hathaway took full control of Geico, he doubled down on this advantage. The company poured money into advertising to build its national brand, but the core operational culture remained obsessively lean. They understood that every dollar saved in overhead was a dollar they could use to lower prices, which in turn attracted more customers, which created greater scale, which allowed them to lower costs even further. It is a virtuous cycle, a flywheel of frugality that crushes competitors who are burdened with a higher cost structure. Now consider Costco. Walk into any Costco warehouse, and you are entering a cathedral of cost consciousness. The floors are bare concrete. The inventory is stacked on industrial steel pallets. There are no fancy displays, no army of sales associates. The business model is built on a few simple, powerful rules. They mark up their products by no more than 15%, a razor-thin margin compared to traditional retail. They carry a limited number of items, which gives them immense buying power with suppliers. They generate most of their profit from the annual membership fee. The entire system is designed to do one thing: deliver the lowest possible price to the member. This culture of frugality is not an accident. It is a religion instilled by its founders, Jim Sinegal and Jeff Brotman. Sinegal was famous for his modest salary, his Spartan office, and his relentless focus on the details of the business. He understood that Costco's low prices were not a marketing gimmick. They were the company's competitive moat. As long as Costco could maintain its cost advantage, it was almost impossible for a competitor to challenge them. Customers would remain fiercely loyal because they trusted that Costco was always on their side, fighting to keep prices low. In both Geico and Costco, frugality is not just about saving money, it is the central pillar of their strategy. It allows them to offer a value proposition that competitors simply cannot match. This is the ultimate expression of the philosophy, a corporate culture so disciplined and so efficient that its very leanness becomes its greatest strength. How does a culture like this persist over decades, through changes in leadership and shifts in the market? The answer lies in the psychological power of habit and the deliberate creation of an alternative to the, quote, institutional imperative. A culture of frugality, once it reaches a certain critical mass, becomes a self-reinforcing system driven by deeply ingrained habits. In his book, The Power of Habit, Charles Duhigg explains that habits operate in a three-step loop: a cue, a routine, and a reward. In a frugal corporate culture, the leadership constantly provides the cues. A CEO who scrutinizes expense reports, who flies coach, who works from a modest office. These actions are daily cues that signal the importance of cost consciousness. The routine is the set of behaviors that employees adopt in response. They learn to double-check expenses, to negotiate harder with suppliers, to find more efficient ways to do their jobs. They internalize the frugal mindset. The reward is twofold. For the company, the reward is higher profitability and a stronger competitive position. For the individual employee, the reward is often more subtle. It can be the praise of a manager for a cost-saving idea, the security of working for a stable and successful company, or even a sense of pride in being part of a disciplined and efficient team. When this loop is repeated thousands of times a day across an entire organization, it ceases to be a set of rules and becomes an unconscious, collective habit. It becomes the way we do things here. This is how you create a culture that endures. This self-reinforcing culture is the only known antidote to the powerful force Buffett calls the institutional imperative. This is the tendency for organizations to fall into a herd mentality. If every other company in the industry has a lavish headquarters, the institutional imperative dictates that your company must have one too. If competitors are all expanding into a trendy new market, the imperative pushes you to follow, regardless of the economics. It's the corporate equivalent of peer pressure. A company with a deeply ingrained habit of frugality is insulated from this pressure. Their identity is built around being different, around being the low-cost leader. They don't mindlessly imitate their peers. They take pride in charting their own, more disciplined course. When competitors are spending lavishly on perks to attract talent, the frugal company attracts a different kind of talent. People who are drawn to the mission of efficiency and value creation. People who would rather have the stability of a low-cost operator than a free lunch. The culture acts as a filter, attracting and retaining employees who are a natural fit and repelling those who are not. This is why a frugal corporate culture, once established, is such a durable moat. It is not a strategy that can be easily copied. A competitor can't simply decide to become frugal overnight. They would have to break thousands of established habits, change the deep-seated assumptions of their entire workforce, and fight against their own institutional history. It is a long, painful process that most are unwilling or unable to undertake. The frugal company, in the meantime, just continues to do what it has always done, its low-cost advantage widening with each passing year. So as an investor, how can you determine if a company's low-cost structure is a true, durable cultural moat or just a temporary tactical advantage? You need a mental model, a cost-culture stress test, to add to your investment checklist. This is a series of diagnostic questions to probe the depth and resilience of a company's financial discipline. Question 1. Is the frugality historical? A true cost-culture moat is built over decades. Look back at the company's history. Was it founded on a low-cost principle? Have its leaders consistently preached the gospel of efficiency throughout its history? A company that has only recently started a cost-cutting initiative in response to a downturn is not a frugal culture. It is a company on a diet. A company that has been lean for 30 years has made frugality a lifestyle. Use historical annual reports, founder biographies, and long-term financial data to answer this question. Question 2. Is the frugality pervasive? Does the culture of cost consciousness extend from the executive suite all the way to the front lines? Glassdoor reviews and articles about the company's operations can be very revealing here. Do employees talk about a company-wide focus on eliminating waste? Or is the frugality limited to certain departments while others are allowed to spend freely? At a company like Costco, the warehouse stocker is just as indoctrinated in the culture of efficiency as the CEO. A truly pervasive culture is hard to break. Question 3. How do they behave in good times? This is the most telling test. Any company can cut costs when its survival is at stake. The true test of a frugal culture is how it behaves during periods of high profitability and booming markets. Does the company maintain its discipline, reinvesting its windfall profits wisely and maintaining its lean structure? Or does it start to believe its own hype, embarking on a spending spree, building a new headquarters, and adding layers of bureaucracy? A company that stays frugal when it's flush with cash has proven that its discipline is a core part of its identity, not just a temporary measure. Question 4. Can they weaponize their cost structure? A truly great, low-cost operator uses their advantage offensively. Look for evidence of this in their competitive behavior. Are they known for initiating price wars that their higher-cost competitors cannot win? Do they consistently gain market share during recessions, when customers become more price-sensitive? Geico's relentless advertising and price competition is a perfect example. They are not just saving money. They are using their cost savings as a weapon to bludgeon the competition. A company that can do this has a moat that is not just defensive, but actively aggressive. By putting a company through this 4-part stress test, you can develop a high degree of confidence in the durability of its competitive advantage. You are looking for a long history, a pervasive culture, discipline in good times, and the ability to use costs as an offensive weapon. A company that passes this test is a rare and valuable find. It is a business built not just for growth, but for enduring market dominance. Finally, we must consider the alternative, the path of the 99% in the context of competitive advantage. This is the path of the race to the middle. Most companies are not run by cartoonishly evil empire builders, nor are they run by saintly frugal stewards. They exist in a vast, indistinct middle ground. They lack a culture of extreme financial discipline, but they also avoid egregious waste. They have average cost structures, average operating margins, and average corporate cultures. And in this mediocrity lies extreme vulnerability. A company in the middle of the pack has no durable competitive advantage. They cannot compete on price because their cost structure is too high to challenge the low-cost leader. They often cannot compete on quality or brand because they don't have the high margins necessary to invest heavily in product innovation or marketing. They are stuck. They compete by imitation, mindlessly following the institutional imperative. They adopt the same technologies, the same management fads, and the same corporate structures as their peers. This leads to a crowded, hyper-competitive industry where no one makes a decent return on capital. They are playing a game of survival, not a game of dominance. The greatest danger for a company in the middle is an economic downturn. When the economy is strong and customers are spending freely, these companies can often look successful. But when a recession hits, their weaknesses are brutally exposed. Customers suddenly become highly price-sensitive and flock to the low-cost provider, like Costco or Geico. The company in the middle is forced to cut prices to compete, but their average cost structure means that cutting prices annihilates their already average profit margins. They are caught in a vice. They start laying off employees, cutting R&D spending, and slashing their marketing budget, the very things they need to do to secure their future. They are in a defensive crouch, simply trying to survive until the economy turns around. The low-cost leader, by contrast, sees the recession as a massive opportunity. Their frugal culture has given them fat profit margins, which act as a shock absorber. They can cut prices even further to gain market share, all while remaining profitable. They can continue to invest for the long term. They emerge from the recession not weaker but stronger, with a larger market share and fewer healthy competitors. The race to the middle is a race to fragility. It is a strategy that works only as long as the economic sun is shining. As an investor, your goal is to avoid these companies. They are the ones most likely to suffer permanent damage during the inevitable storms of the business cycle. Your focus should be on the outliers, the companies at one extreme with a durable, low-cost moat, and perhaps companies at the other extreme with an incredibly powerful brand or technological advantage. The vast, undifferentiated middle is a graveyard for capital. It is where mediocrity gets punished, and where the unbeatable advantage of a frugal, disciplined culture truly proves its worth. The direct financial connection between a frugal culture and a competitive moat is clear, quantifiable, and profound. It manifests across several key lines of the financial statements, ultimately leading to superior pricing power and a higher long-term valuation. First, let's revisit the income statement. A deeply ingrained low-cost culture directly attacks both the cost of goods sold, COGS, and the selling, general, and administrative SG&A expenses. A company like Costco uses its massive scale and no-frills approach to negotiate better prices from suppliers, lowering its COGS. A company like Geico eliminates an entire layer of cost, the agents, dramatically reducing its SG&A. This two-pronged attack on the expense structure results in consistently higher gross margins and operating margins compared to competitors. Let's quantify this. Imagine two retailers. Retailer A is a low-cost leader with a gross margin of 15% and an SG&A expense of 5% of sales for an operating margin of 10%. Retailer B is a middle-of-the-pack competitor with a gross margin of 25% because they have less buying power, but an SG&A expense of 20% due to fancier stores and more staff for an operating margin of only 5%. Retailer A, the frugal operator, is twice as profitable on every dollar of sales. This superior profitability is not just a number on a page. It is a strategic war chest. It gives the company immense pricing power. Pricing power is the ability to raise prices without losing significant business to competitors. The low-cost leader has an inverse, but even more powerful version of this: the ability to lower prices and destroy competitors. If Retailer A wanted to start a price war, they could cut their prices by 5% across the board. Their operating margin would fall to 5%, but they would still be profitable. If Retailer B tried to match that price cut, their operating margin would fall to 0. They would be bleeding cash, unable to sustain the fight. The frugal company's cost structure is a weapon that dictates the terms of competition in the entire industry. This translates directly into a higher and more sustainable valuation. The market recognizes that a company with a durable cost advantage is less risky and has better long-term growth prospects. It will be able to generate more free cash flow over the long run. As a result, investors are willing to pay a higher multiple, a higher price-to-earnings or price-to-free cash flow ratio for its stock. A 2% sustained advantage in operating margin, compounded over 20 years of growth, can translate into a 50% or even 100% higher valuation for the business. This is the ultimate financial payoff. It is the end game of the entire philosophy. The focus on an owner's mindset, the Spartan headquarters, the disciplined capital allocation, it all flows down to this single powerful outcome. A business so efficient and so dominant that it becomes a true compounding machine for shareholder wealth, a fortress of value in a world of fleeting corporate fads. You have just spent this time absorbing a powerful mental tool, a lens that will forever change the way you look at a business. You have moved beyond the superficial numbers on a spreadsheet and learned to read the subtle but critical language of corporate culture. You now understand that the true measure of a CEO is not their charisma or their grand vision, but their discipline. You have learned to see frugality not as cheapness, but as a profound respect for shareholder capital. You have learned that the clues to a company's future success are often found not in its press releases, but in the thread count of its carpet, the location of its headquarters, and the track record of its capital allocation. This is a rare and valuable perspective, a significant piece of the intellectual arsenal required for long-term investing success. But it is crucial to understand that what you have just mastered is a single powerful node in a much larger network of mental models. Warren Buffett's system is not a checklist, it is an interconnected web of principles. The principle of frugal leadership is deeply intertwined with his concepts of circle of competence, Mr. Market, and the competitive moat. Each principle strengthens and informs the others. You have acquired one piece of a map, a crucial piece, that reveals the character of the people running a business. But the map is vast, and there are other, equally powerful pieces that reveal the quality of the business itself and the price at which it becomes a bargain. The journey to true financial freedom is a journey of assembling this complete mental arsenal. And right now, on your screen, is the opportunity to acquire the next piece of that map. The video that is about to play is not a random recommendation. It is the missing link, the connection between the principle you have just learned and the next critical component of the system. It is the bridge between understanding the jockey and understanding the horse. To click away is to leave your map incomplete. To continue is to add another layer of sophistication to your analysis. To move one step closer to seeing the world of business and investment with the clarity of its greatest masters. The choice, as always, is yours. But for those who are serious about their ascent, for those who are not content with surface-level knowledge, for those who are committed to completing their mental toolkit, the path forward is clear. Click and continue the journey.